Hey, it's Rick. It's Friday, October 27th. Last day of the week. We're only a couple of days from the end of October. There's two more trading days in October. So I thought I would do in this video is step back a little bit and look at things from a longer term perspective to try to get some insight in what my plan will likely be for the next 2 or 3 months. So I have up here the S&P 500, the spiders, on a 1 month chart. These are monthly bars. And this goes back 15, 16 years. And so hopefully this shows up okay on your monitors. You can see now, barring a miracle on Monday and Tuesday, we're going to have 3 consecutive down months. Let me just highlight this. Yeah. And this doesn't happen very often. In fact, if we go back, we have to come back to find 3 months consecutive. We have to go back to the COVID lows. So in here, we had 3 months consecutively down. Then we have to go back further. Here we had 3 more back in February 2016. Just going to highlight these. And then we have to go back to 2011. And here we had actually 5 months of declines. And then that's 2, and here we have to go back to 2008 into the financial crisis. And we had, here we had 1, 2, 3, 4, 5 months down. Got a couple of very small gains after that, and then 1, 2, and then I'm up. So really we had this batch in here. This was like super bad. So like I say, this doesn't happen very often. This is going back 16 years, and we got 6 instances where the market has gone down for 3 consecutive months. So the probabilities suggest that we should bounce from here into the end of the year. And historically, November and December have been pretty good months. So I mean, it's too early. Right now, I'm at 11% invested. I just have one decent sized position and one tiny position, and the rest is cash. I've been that way for a while and have no desire to get active until things turn around here. But it's likely to happen in November and December. So we'll dive in a little bit deeper in a little bit. The worry, though, is that we get. You can see what happened here when we did have 3 months down. We had the COVID, and then look what happened after that. Beautiful uptrend. And then back here in 2016, we had 3 consecutive months down, and then we went into another beautiful uptrend. And the same thing back in 2011. This was 5 months of pain. Well, not pain if you're in cash, but a lot of waiting time, and then another gorgeous uptrend. And then this nonsense back here in 2008, even though when you came out of that, it was a decent uptrend that followed that. What I worry about, of course, is a repeat of something like 2007, early 2008, where we had 4 or 5 months, 5 months down, got a couple of blips up, and then a big, huge crash. So am I predicting that this time around? No. But we have to protect ourselves. I mean, that's why we have stops, because we could get that. We could get a nice little, November could be a green month. December could be another green month coming into here, and then all hell breaks loose in January, February, March. And so we just have to be protective of that. So that's the S&P 500. I'm looking at the equal weight S&P 500, which is the ticker symbol is RSP. It is less influenced by the big, what we now refer to as the Magnificent Seven, if you like. And you can see it's a little bit different picture here. Those of you that have been watching my videos for some time, if you recall, in January, I was saying the market would be real easy if we just go up, right? That's a real easy market. Another real easy market is if we just go straight down, is if we just stay in cash. And the worst kind of a market that you can get into is what we've actually experienced, where we just chopped around for a whole bloody year and gone nowhere. And that's an environment that's very, very difficult to make any progress in your account equity. I mean, I'm still slightly positive for the year, but and thankful of that, I guess. But yeah, it's been a really tough environment for the whole year because we've had this sort of a chop. Looking at a couple of the other indexes, like NASDAQ, not much different. We got 3 months down. Where we go from here, it's going to be very similar to the S&P. Mid caps, a lot weaker. You can see here we've had the same sort of chop as we get in the RSP. We've had zero progress now for going on 2 years. And if you're in the small caps, we're really back to the pre-COVID highs. So it really hasn't, anybody that was long the small caps, the IWM from back here in 2018 is made zero progress. We're right where we were after 5 years. So that's kind of disappointing. So the other things I follow are what's the bond market doing? So, whoops, that hasn't been good. But I mean, this is not surprising because interest rates have started to rise or have been rising for some period of time. And that's not good for bonds. So this has been a terrible place to be. U.S. Treasuries, pretty much the same picture as bonds, straight down. Now, I think, you know, if you look at, we could look at a smaller time frame chart. There's signs that there may be a bottoming here, but I don't bottom fish. I got to wait until things are heading right back up. Gold is looking interesting. This one is got an enormous sort of cup and handle here. And then it's been bouncing around near these highs. So the gold potentially could be really good. The difficulty I have with this, based on this time frame and even into a weekly time frame, I can't find an entry that will give me a really good risk reward quite yet. So this may take a few more weeks to develop out. And then, of course, Bitcoin. Bitcoin was up like 13% last week, but on a longer term chart, this has no interest to me. It's all over the map. So that's my take on the bigger picture. So let's go back to RSP, and we'll remove all these drawings. Remove, I think we can do this. Remove drawings, there we go. And we'll go down to a weekly chart. Oh, never mind. What I was going to point out on the monthly chart was really quite evident that the volume, which is represented by these candles down here, has really picked up with this RSP in the past 3 years. So more and more, it seems evident that more and more institutional fund managers are now using this as a proxy for the market as a whole. I mean, the volume is still on a weekly basis. This is a big week here. It was like 40 million shares. And I think the S&P for the week was more like 300 million shares. So it still pales, but it is really growing. Okay, so what is this weekly chart of the RSP telling me? just spread this out a bit. So if my premise is correct, that between now and December, let me just put, I'm going to put something on here. 1 second. January. Okay, January. Okay, what this line here, this, I don't know how well that shows up. I can probably make that a little bolder. Make that a little bigger. This is a volume weighted moving average. So basically, this is the average price that people have paid for this instrument since the beginning of the year. So it's, without going into it in depth, if you're trading above the average volume weighted price, it really tells you that the bulls are in control. And when you get below the volume weighted price, the bears are in control, and there's no time to be long. And then obviously it crosses back and forth. So we're in a period here where it's just not bullish whatsoever. If anybody is interested, there's a fantastic book called Anchored VWAP. The author is Brian Shannon, and I've just been incorporating this into my toolkit here for the last 2 or 3 months, and it's I'm finding it very, very, very useful. So I'm going to do a couple more things here. I'm going to draw a couple of anchored volume weighted averages. I'm going to pick the high, which is back in January of 2022. And what's the volume weighted moving average from there? And then pick the low, which was set in here in October of 2022. And it's an interesting thing here. These all converge right pretty much in the same area. So here's my plan, if you like. I believe, so between now and the end of December, November, December generally are stronger. And we've been down for 3 months, which generally means the probabilities are we're going to have a bit of a bounce. Okay, so if I start drawing in some lines of what the next 8 weeks could look like, it could be something like this, which will be quite a tradable little move. It's overlap, but I think you get the idea. But when we get up to here, into this area here, that to me is going to prove a lot of resistance. So my plan would be, if we start to turn around on Monday, Tuesday, Wednesday, sometime next week, if we are starting to head back up, I'm going to get a little bit more aggressive, then progressively more aggressive as it proves itself. And once we get up, though, into this area here, I will start to lighten up. And a lot of traders and money managers and advisors will be starting to load the boat a bit more, thinking, hey, we've turned the corner, this is going to rip back up. But I think there's a decent probability, unless we don't get into a recession, if the wars start to get settled out, if interest rates settle down, a lot of good things could happen, and this can continue to rip higher. Great, I'm all over it. I will lighten up in here, and then maybe have to rebuy things back again as it continues to go up. I'm okay with that. But if it flips over, it comes back down, I want some protection. So I will be, that's sort of a general framework that I'm looking at for between now and January the 1st. I don't know how helpful that is to you guys, but that's it for what it's worth. Okay, I'm going to call it a day, and like I say, I'm still staying in cash, and we'll next week, not going to get too aggressive. We need to see a clear sign that things are starting to turn around. Okay, cheers, everyone.